Hi, everyone. It's John Pocoroba. I thought I would do a brief market update given some of the changing market conditions. I hope everybody's having an opportunity to enjoy the Labor Day weekend. So again, as a reminder, the presentation's by Rain King LLC, and I'm an individual growth stock investor, not affiliated with MarketSmith or IBD. So our agenda is to go over a market overview. Also, we're going to talk about some of the changing internals in the market and why we need to be very, very flexible. And then coming back to the question, was the rally we experienced a bear market rally, or is it a new bull market? So let's look at the big picture of the market. I've shown this chart before. The last time we spoke, we looked at this rally up into the 200-day moving average, and we had very good breadth, good volume on the rally. But since then, in the past 3 weeks, we've had really new information. We've had the internals that are weakening, and we're going to look at that in a moment. And the sharpness of this pullback. The question is this normal? Now, this is a chart that I'll take my time to explain a little bit. The thing that's changed is the Fed. Powell had made his comments about some more pain ahead, and their sole focus is fighting inflation. And he specifically mentioned they weren't going to make the mistake of the 1970s. So if we look at the 70s, this is almost a decade chart from 1970 all the way out to 1980, 81. And I've plotted in white the inflation rate during that time period. And also in dark blue here, this is the Fed funds rate. So when inflation was starting to really pick up in 73, 74, this yellow zone is the recession that occurred. There's the bear market of 73, 74. So inflation got up to 12%, and the Fed started hiking rates aggressively. What happened, though, in the 70s was they started to knock down inflation. You can see inflation comes back down from 12% down to 5%. So the Fed took their foot off the gas and started to reduce rates. And now the problem is they did not kill inflation. As you can see here in the white line, inflation starts to pick up again. In the next couple of years, it got as high as 13%. And the Fed basically had to start over with aggressive rate hikes when Paul Volcker took over. And he really, really raised it aggressively enough to kill inflation, but it took a couple of years and 2 mini recessions. This is what the Fed's talking about, not making the mistake of the 1970s, where they took their foot off the gas and didn't fully get the job done. So let's look at these internals I've mentioned. 2 weeks ago, I mentioned on the S&P 500, we had a very strong breadth thrust above the 50-day moving average, the number of stocks above the 50-day. And we noted that here, when you get to 90%, it's a very rare, strong thrust. And probably noteworthy from Shavako Capital was 72% of the time the drawdowns are fairly modest, less than 6%. So where are we today? Well, in the past couple of weeks, you can see there's been a rapid decline, and this is concerning. We blew through this drawdown average of 6% really, really quickly. So that's concerning that this breadth thrust has turned around so rapidly. Now, this is the New York advanced decline line on a weekly basis. And a couple of weeks ago, we were looking at this. I put this chart up, and we had broken the downtrend line, which was very positive. And we noticed that we had exceeded the shorter term peak that occurred back in May. And that was very positive before the index had cleared that peak. So things looked really, really good in early August. Now, since then, this is where we are today. There's been rapid deterioration. We've come back below the May peak. So things are no looking that good anymore, as we are very sharply turned away in the advanced decline line. So that's not a positive. Also, some of the early bull sectors, typically we'll see the consumer discretionary sector, the builders, the broker dealers. The broker dealers usually do well, very well, and lead the market, have bull markets. These were all looking very, very positive on the rally. And you'll notice that, a lot of that was baked into anticipating the Fed was going to stop with aggressive rate hikes. and maybe we could avoid a recession. That idea seems to be pushed down the road now. The market is readjusting to Powell's commitment to lowering inflation. You will notice that some of these are testing the 50-day moving average. So, all hope is not lost that maybe we do hold the 50-day and stabilize, but certainly it's at a pretty critical juncture right now. So the real question is, is in the Nasdaq, if we look at this pullback, asking ourselves, is this a normal pullback that could be a retest, or is this acting abnormally? So I come back to this chart that I've shown before, just to refresh. This rally was very strong. We had multiple follow-through days. We had the power trend was on, which is very positive, and we had 2 Eureka thrusts. So this is a very strong thrust, which gave some credence to possibly the retest scenario that I've outlined. So the question is, where are we now? Now, we marked down some on a previous chart. These were some typical pullbacks we might experience that would probably be in the realm of being normal. 3%, 5% took us down to the 21-day moving average, and even a decline down to the 12,000 level was about a 9% decline down to the 50-day. We could understand that as all being normal. But things have really started to deteriorate. You say, well, what about these breadth thrusts that looked so good for the month of July and partially through August? Here's the daily chart of the Nasdaq. Here's where we are today. Now, these breadth thrusts, which look so good, were positive for the market. But as I emphasized, the whole point of this video is we must be flexible, and we should evaluate what's happening in the market and what is it telling us. So first thing is, as I shown you, the internals are weakening rapidly in the market. We're starting to see new lows kick back in. The advanced decline line has been turned away, and the number of stocks above the 50 days have dropped dramatically in the S&P. So that's a negative. Second, these drawdown levels that we were anticipating as some possible support are not holding. I've also drawn a kind of a short-term trend line. You can see that's been broken as well. I showed you 3 early bull sectors, the XLY, the XHB, and the broker-dealer index. They've been kind of stopped right in their tracks and turned away. All hope is not lost. They're at the 50-day, but they're certainly, the rubber is meeting the road there. So at the moment, that's negative. They've been turned away. On the Nasdaq, there have been multiple days of distribution in the past week since Jackson Hole, and they're starting to cluster. That's a negative as well. And the power trend we mentioned, that's turned off now. There's a 10% decline off the top circuit breaker, which turns the power trend off. So the power trend now is no longer in play, negating the thrust we had in the rally. And as you can see, the 50-day moving average has been broken, and we haven't been able to get much of a rally at all since Jackson Hole. It's been pretty much a straight down decline. Now, former growth leaders, some of the old bull market leaders, are actually making new lows before the indexes. So we always emphasize, look for new merchandise and don't look at the former growth leaders. They're actually very, very weak and breaking to new lows. Now, the new growth leaders, there are a few of them, but not many. There's probably a good, 5 to 10 that are holding up. We don't know if that's going to remain in play, but they are new leaders that we should watch carefully as the market progresses. So in a summary, all of these signs to me say this is not really a normal looking pullback within the scenario of a retest. Now that could change. We look at the market every day, but at the moment, this doesn't look great for the market. So the retest scenario is really getting right to the point where I mentioned the retest off the lows. This is where the rubber meets the road. Either after Labor Day, either the pros are going to step in and buy and support this market, or they're going to continue to sell and liquidate positions, anticipating more pain with rate hikes and potentially a recession. So we are at the critical stage right now where the market either has to put up or shut up. And if we don't have the retest get support, then I put this chart back up, which I showed many months ago about the psychology behind bear markets. And we had talked about leg one down, leg two down. We could be in, if we don't get the retest, we could actually create new lows. The next rally would fail. The psychology would be behind that is everyone would see this next decline. Everybody's already talking about how we're going lower. So it really becomes obvious to the crowd. And it's very possible breaking the lows could occur and people would panic and throw in the towel, sell everything as we break to new lows. So that scenario is certainly a possibility. I don't think the retest scenario is completely off the table, but the market has to show stability very, very quickly in order to keep that in play. So that's all the time I have for now. I appreciate it that you're listening to this on a holiday weekend. Encourage any comments or feedback that you have, and I'll see you on the next general market update.